Hey, everybody. Thursday. It is the day before Friday. Friday Eve. That's it. Friday Eve. That's always a good thing. How's everyone doing today? Can you hear and see me okay? Boy, usually, Gene, you are in here like right at the hop, and I don't see anything in the chat here. Can everybody hear and see me? There we go. Happy Friday Eve, everyone. Who is in the house that can say hi to me so I know that we are live and running well here? Gus, thank you. Thank you. Thank you. Thank you. All right. There we go. Ahoy, Brad. All right. For all the regulars and everything, subscribe, smash that like. Everybody else, please do the same. Rocky Mountain Chainsaw, which options are you talking about? Oh, the 5. Oh, 5. Yes. Yo, you must have cleaned up on that. Nicely done. I'm glad you got out because the stock is only up $6 now. It was up like 14 or 15 earlier. So nicely done. Nicely done. I'm glad that you were all over that. Okay, guys. Little market update here. I'm not sure what just came out other than what seems to be the gloves coming off between Elon Musk and President Trump. We just went from the S&Ps up about 20 points to down 15 points just now. More and more that comes out between those two. The last big headline I just saw right now, and don't really know why that would cause the market to move, but Elon Musk said that President Trump would have never won if it weren't for him. The gloves are off, and if nothing else, guys, this should be some great theater between the two of them. So we'll be watching that one. This should be really, really interesting. But other than that, it was another pretty calm day here, leading into tomorrow's jobs report. The big non-farm payroll report, where they're looking for, the estimates are 125,000 jobs. Now, yesterday's ADP report was so light, 37,000. They were expecting 110,000. That's what kind of hit interest rates a little bit. The market, I guess, liked it. But if we see that kind of miss tomorrow, I think the markets could really pull back. Even though if the jobs report is light tomorrow, that would potentially be I don't want to say a good thing, but let's say a positive towards the Fed maybe lowering rates sooner. The problem is we have to really be careful what we wish for, because if the Fed starts lowering rates for the wrong reasons, that's not a good thing. That's not a good thing. But certainly after the ECB lowered rates again this morning, I'm sure we're going to see the President Trump, Jerome Powell tiff pick up a little bit. How would that be? How would that be? Anybody here like a professional, I do that with quotes, wrestling fan, WWF or whatever? Anybody a fan there? I think it'd be pretty cool to have like a steel cage match with the three of them in there and only one comes out, right? Trump, Musk, and Powell all in a cage match. I think that would be pretty fun to watch. But I think the headlines on this stuff is going to be interesting, to say the least. All right, straddles and strangles. Straddles and strangles. Okay. First off, okay, why are they called straddles and strangles? Okay, so the way that when I first learned option terminology, was a straddle means you're kind of straddling the fence. You're straddling where the stock is right now. So basically when we talk about straddles, we talk about the at the money straddle. So you're kind of coming at it, right on line with where the stock is. Versus a strangle, the way that I learned what a strangle was is I'm coming at it from both above and below, like, literally a strangle. So I'm coming at it with calls way above and puts way below. Hello, Ralph. when you were 10, Brad? Is that for the WWF? You know what? I think we're going to have to maybe change the Hulk icon in here to maybe a big WWF superstar or someone from old time wrestling. Anybody that may have been here in Chicago watching, like the Bruiser and the Crusher. All right. So anyway, strangle and straddle option strategies. Okay. Directional and lets you really take a stance on volatility. Okay. Typically, if someone is just going to buy a straddle or a strangle, you want to do it when premium option volatility is relatively cheap, relatively inexpensive. Okay, because the lower the implied vol, the less this is going to cost you. And if you buy a straddle or a strangle, okay, you don't care which direction the stock moves. You're just looking for a big move, a swing in either direction. Okay, now straddles, because we're looking at options that are right at the money, are always going to cost more than a strangle where you're looking at typically out of the money calls, out of the money puts. Okay, so a long straddle is going to cost you more, but also offers much quicker profitability. A long strangle, where you're long both a call and a put, you've got a little ways to go on either end before you start making some dough. Okay, so straddle, same strike price and expiration date for both the call and the put. Okay, strangle, also the same expiration date, but we're looking at different strike prices. Typically, the put lower, so out of the money put, the call higher, out of the money call. Okay, like I just mentioned, quicker potential profits on a straddle because you've got options that will get affected more by a quick move in the stock because they were at the money options. You can kind of look at it as a delta thing. You know, in a straddle, each option is essentially a 50 delta option. Okay. No, Rocky Mountain, we do strangle swaps, which we'll get into. Okay. On a strangle, okay, you need a larger change in where the underlying is going for those options to increase in value. Okay, obviously you can be short these also. You can be long them, you can be short them. I'd rather be short them when volatility is really, really expensive, but I would never trade them just as a naked short straddle or short strangle. Because why? Because we would then have unlimited risk. If you are just short a call and a put, you have unlimited risk, which is why, as we did this morning in Robinhood, in Hood, which is why we did a strangle swap. We sold a really expensive strangle that expires next week, volatility-wise, and bought one against it the following week out. Much cheaper, volatility-wise. That is a position we were looking for to make money on volatility. So this is what a long strangle would look like. Okay, and somebody give me a stock you want me to put up on the board here. Let's see what the first one is here. Upstart. Oh, no. AVGO slid in just beforehand. AVGO is a good one with earnings later today. Okay. Here's AVGO. Okay. Stock is trading, 263-ish. Right there. Okay. So a straddle, which can really be any strike, but typically we refer to it as the at the money strike. A straddle would be buying both this call and this put. And you can see that cost about $18. Okay, a strangle would be going out of the money on either side. So what do I mean by that? Let's say we look at the 250 put and the 280 call. Okay, that is going to cost much, much less. That's going to cost somewhere in the range of about $6.50. Okay, now, as you might think, something that costs me a lot less probably does not give me the potential return right away is something that costs me more, right? It's that trade-off of if I'm taking more risk, I better get more reward. Less risk, I'm probably going to take a little less reward. Okay, so let's go through here how this strangle to start with in AVGO looks from a P&L. So this is what a typical strangle looks like. So the losses down here would be what your premium that you paid. And then you won't start making money until you get a nice move in either direction. Okay, so let's go back to here and let's put up exactly what this looks like. And we'll put this on tomorrow's date. And here you go. So you've got those losses right here. And if you exceed those ranges on either end, okay, that's when you really start profiting. Okay, does everybody see that? This right here, this area of negativity, of loss, is due to the fact that the stock just stayed in place. Remember, if you own one of these positions, a straddle or a strangle, you're doing that with the hopes of a big move in either direction. All right. Now, a short strangle, which you absolutely can trade as well. I would never trade a short strangle on its own without being hedged, is going to be the absolute opposite. It's going to be, up on its head. So you make money. You make money here if the stock doesn't move, and all you can capture is the premium. But then if you do get a big move in either direction, you've got unlimited risk down to zero on the downside, but true unlimited risk on the upside. Okay, so in the case of Robinhood, today we sold a strangle, but we bought a strangle against it. We sold next week's out of the money put, out of the money call, and we bought the following week out of the money call, out of the money put, and it was a big volatility play. Just looking for that volatility to normalize. Okay, now a straddle versus a strangle, you can see is much different shape. Instead of the shape like that, you've got a much sharper, much quicker move in your P&L depending on what the stock does. And again, that's because you're using at the money options, so they have much larger deltas to them. So they react quicker than out of the money. So let me get up on the screen now. We'll do the same thing in AVGO, but we will look at the at the money straddle. So let's look at buying this and buying this. Okay, like we had said, that's about $18. And if I run the risk chart on this, whoop, there's got to be something else I'm missing in here. What am I missing? Nothing. Call in the put. Okay. Let's do this and get the expiration correct on it. There we go. Okay, so what you will see here, if we were to put the two of these next to each other, is this area of loss. It's a tighter area. Now, there's deeper loss potential because you're paying more, but it's a much tighter area. And then the potential gains really kick in a lot quicker. Okay, now, if I was to buy one of these on its own, again, I would never sell one on its own without having a hedge. But if I was to buy one of these, I'd want to do it when volatility is cheap. I don't want to pay a lot for that muffler. I don't want to pay a lot for that straddle. I don't want to pay a lot for that strangle. And that's all measured by implied volatility. Okay. All right. Straddle definition: buy both a call and a put, same strike price and expiration date. So if you look in this example right here on a $50 strike price, okay, let's say the call and the put are $3 each. So you're paying $6 for that straddle. Well, you would need a move of approximately $12 to potentially, 12%, $6 to potentially profit here. Okay, does that make sense to everyone? Okay. Now, the long straddle, just like on any other debit spread we would trade, the most you could lose is what you pay. That's your investment. Okay, so if the stock doesn't moves, not enough, you cannot lose more than you pay. As we said, if you're long a straddle to the upside, you theoretically have unlimited profit potential because the stock can continue to go up, 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 up. And on the downside, you have unlimited profit potential down to zero. Short straddle is just the opposite. Sure, you can absolutely sell a straddle. The most you could make is the premium collected. Your risk, though, on the downside is down to zero. On the upside, unlimited. So if you tried to trade a naked straddle or a naked strangle in your account, you might get a big no-no from your brokerage account because it is unlimited risk. Let's shoot on up to the Hulk here. Our word of the day is move, because if you're buying a straddle or a strangle, you want the stock to move. So let's get that into the word of the day. All of you who are here. Thank you, Victor. Elon Musk says Trump would have lost the 2024 election without him. Ooh, it's heating up. It is heating up. All right. Strangle. Okay, we already talked about out of the money call, out of the money put. Okay, so in that same example that we just went through with the straddle on a $50 stock price, where in the straddle we bought the 50 call, the 50 put. Excuse me. Here, you might buy the 55 call up above, the 45 put below. Let's say in this case it cost $4. That's the kind of move you would need. Okay, you can also have a bias on your strangle. You don't have to buy the out of the money call, out of the money put, which are equidistant away. If you wanted to take a little bit of a delta bias, like in this instance here with the stock at 50, maybe you want that strangle, but you're a little bit more bullish than bearish. All right, so maybe you buy the 52 call and the 45 put. Okay, so it doesn't necessarily have to be equidistant, just like when we trade some of our iron condors, guys. Sometimes we do them where either the put side or the call side is not the same distance away, and that gives us a little more directional bias. Okay, now not sure what had come out which had caused the market to go down about 25 or 30 S&P points. But since we started, we are back positive. S&Ps are back up 7. Okay, so long strangle, just like a long straddle or any other debit, you cannot lose more than you pay. Unlimited profit potential on the upside, unlimited profit potential down to 0 on the downside. Okay, and then the opposite is also true if you are short a strangle. Now, let's take a look at our Robinhood position. Okay, because all we did here is sell a strangle, which you might be like, Scott, you just told me you would never sell a strangle. I said, no, I would never sell it naked. Good thing I'm wearing my Prosper golf shirt today. I would never sell it naked without any long options against it. So what we are doing in this case, selling this week's strangle to capture that really expensive premium and buying the exact same strikes the following week. Or not this week, it's the 13th and the 20th. Okay, and if you see why we're doing that, okay, here's the option chain for next week. You can see these puts are up at about an 87% implied vol. These calls are up at about a 92%. Super expensive for Robinhood, super expensive. And if we go out one further week, there is a considerable drop in implied volatility. So in a strangle swap, which is the position that we have on, where do we want the stock to go? Okay. Either way is fine, but where? Ah, there we go. Kevin, Bill, boom. Our preference, John, would not be outside of the shorts. Our preference would be to either of the shorts. Not even in between, Kent. In between on an iron condor would be great. In between here, I mean, if it's close to one of those strikes, that's great. You know, if you're at 66, 67, or 83, 84, great. But in a strangle swap here, we're looking at, we want this to get to as close to 0, while this either keeps its value or actually increases its value. Well, where is that going to happen? That is going to happen at either of those shorts. If we start moving too far outside the shorts, we're going to lose some of the premium. And if we don't move enough, if we stay in between, especially right in between, like, you know, Stock right now is 72 or 74, right in between. If we stay there, that's not going to be a good thing. So let me show you what this risk chart looks like. Okay, there we go. So we want to move to those short strikes. Change the date up here to tomorrow. There we go. We want to move to these short strike area. That's where the profitability is. Okay, we want those calls and puts expiring on the shorts to be as worthless as possible, while the other ones we have are as expensive as possible. All right, everybody. Final call. You see it on the screen. Move, move, move. Move, move, move. Any other last entries getting in there? Any questions on the difference between straddles and strangles? Okay, we got a few late entries in here. Michael, hopefully we got them on the wheel. Profit target, Clive. That is a good one. Profit target on something like this is usually a little less than 1-to-1. But because you have different expirations, you can't really just ballpark it and say, okay, what's my reward and risk on this? I'm paying 85 cents for this. What can I make? What you have to do is actually put it out there on a risk P&L, make sure your volatilities are correct, and then look at what that P&L is on expiration day of the shorts. Let me put it up here again. Got to put the date all the way up there. Okay, so I moved the date all the way ahead to the short. Okay, and here you go. You can see here's the profit peak at the short put. Here's the profit peak at the short call. And the range of profitability is pretty wide. We just don't want the stock to settle in right here. All right, I understand that the wheel is closed. Yes, I see the wheel in front of me here. Let's bring it into the room. All right. Should we let it rip here? Let's do it. All right, it's going to be Victor, Valerie, Thomas. It's close. It is close. Thomas. Oh, Victor, you were literally one Cheerio away. Thomas, are you in the house? Thomas, I hope you're still here. I know you were here earlier. Uh-oh. Thomas. Oh, boy. Oh, boy. We'll give him 10 seconds, folks, and then we're going to go to a new spin. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Thomas. Oh. All right. Too late. We're spinning again, guys. We're spinning again. Here we go. All right. Who is Just Gary? Who is Just Gary? Speak up. Oh, Thomas. Now you appear? Oh, man. Boy, what do you guys think about Thomas here? Gary, you're locked in as a winner. Thomas, come on. Everybody wants to hear you say, please, 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 can I win? I see your text right now, Thomas. You didn't answer after you won, but we'll give it to you, Thomas. He was here on time. Thank you, Daniel. So double winners today, Thomas and Gary. Awesome. Okay. So both of you, you see the email on the screen, prosperswag@prospertrading.com. Thomas, Gary, send me your response or send me an email, size swag, mailing address. Happy to get you both some swag. All right, everybody. It is Friday Eve already. That is a great thing. And we will see everybody tomorrow. And don't forget, non-farm payroll report, jobs report tomorrow morning. Could be a market mover. All right, everybody. Appreciate you. We'll see you later. Bye-bye.